Have you ever felt, like just swamped trying to get the real story out of a company's financial reports? All those crucial insights are definitely in there, but finding them, it can feel like looking for a needle in a haystack. Well, today we're going to cut through all that noise for you. We are embarking on a deep dive into the Q1 FY26 financial results of JM Financial Limited. Our mission here is to distill the really important nuggets from their official disclosures. Everything from the board meeting outcome, the statutory auditors' reports, right through to their press release and investor presentation. Think of this as your shortcut to being genuinely well informed. We'll spotlight the surprising facts, the key performance indicators that truly matter, without that feeling of information overload. So let's jump right into the big numbers, shall we? JM Financial's first quarter for fiscal year 2026, that's ending June 30, 2025, delivered some truly eye-popping results. The consolidated net profit for the quarter, it soared to Rs 454 crore. That's a staggering 166% increase year over year. And this also happens to be their highest ever quarterly operating profit after tax. When you see a jump like that, what's the first thing you look for to understand the quality of that growth?
That's a crucial question, because beyond that impressive percentage, what truly stands out here is the company's net worth. It has now crossed the Rs 10,000 crore mark. And with a book value per share around Rs 1 of 6.4, these figures aren't just big numbers. They really signal a fundamental strengthening of their financial bedrock, providing a much more robust foundation for whatever they do next.
And the positive momentum wasn't just stuck on the bottom line, right? Net revenue saw a pretty healthy 22% increase year over year, hitting Rs 779 crore. And pre-provisioning operating profit, that also climbed 22% year over year to Rs 389 crore.
Yeah, and zooming out a bit, that strong pre-provisioning operating profit, or PPOP, is a really positive sign. It points towards robust core operational efficiency before they even account for potential credit losses. So it's a clear measure of how well their underlying businesses are actually generating profit. Shows a healthy operational engine.
Okay, right. Let's unpack this a bit more. Beyond those impressive raw numbers, JM Financial has been incredibly active. Some significant strategic adjustments, corporate maneuvers this quarter. The biggest news, perhaps, their complete reclassification of business segments. They formally revised their operating segments for Q1 FY26. And they state this move aligns with and I'm quoting here, sharp focus on emerging opportunities, deepening client engagement, and ensuring optimum and efficient capital allocation. So what used to be investment bank, mortgage lending, alternative and distressed credit, and that big AWS segment has now been reorganized into four new reportable segments: corporate advisory and capital markets, wealth and asset management, private markets, and affordable home loans. Treasury and others now just captures unallocated surplus funds.
And this raises an important question, doesn't it? Why do such a significant reclassification? It's not just shuffling deck chairs or an accounting formality. It really signals a deliberate, quite strategic shift in how they view and manage their core operations. By reorganizing like this, they're aiming for, well, clearer performance tracking against specific strategic goals. It lets them allocate capital maybe more efficiently to areas they see having the highest potential. It's about sharpening their focus, maybe gaining agility.
And that strategic realignment, that's just one piece of the puzzle. They've also been busy with two pretty significant transactions that really highlight this active portfolio management. First, they fully acquired JM Financial Credit Solutions Limited, JMFCSL, bought the remaining, 2.98% equity shares for Rs 89 crore, making it a 100% wholly owned subsidiary, so full control there. But then they also entered a strategic investment agreement, this one's with Bajaj Allianz Life Insurance Company Limited, for JM Financial Home Loans Limited, JMFHLL. Bajaj Allianz is set to acquire a 2.1% stake in JMFHLL for Rs 65.5 crore, which interestingly values that whole home loans business at roughly Rs 3,120 crore. That means JM Financial's effective shareholding in JMFHLL adjusts slightly from 98.76% down to 96.66%.
Yes, and what's particularly telling about that Bajaj Allianz transaction is Vishal Company, the vice chairman and MD, noting that it, quote, created a benchmark valuation of over Rs 3,000 crore for the home loans business, which has been built bottoms up over the last 7 years, end quote. Now, that kind of external validation, especially from a major player like Bajaj Allianz, it isn't just a number on a page. It's a significant indicator of the perceived market value, the strategic importance of that segment. It kind of confirms the success of their organic growth efforts there.
Interesting point. And speaking of strategic moves, their private wealth business that was transferred to JM Financial Services Limited, another wholly owned subsidiary, via something called a slump sale, effective April 1st, 2025, for 8.45 crore. and it's now classified under discontinued operations in their standalone results. Just quickly for our listeners, can you explain what a slump sale signifies here?
Absolutely.
Yeah.
Yeah, a stump sale, in simple terms, is when a company sells an entire business unit sort of as a package deal. So that includes all its assets and liabilities rather than selling off individual bits and pieces. In this case, it seems to streamline JM Financial's operations by consolidating their private wealth activities under that wholly owned subsidiary, which aligns really with that broader strategic focus we were just talking about, sharpening things up.
Right. Makes sense. So we've covered the big picture numbers, the strategic reshuffling. Now, the real test. How have these newly reclassified segments actually performed in Q1? Where's the standout growth story in this new structure?
Well, without a doubt, corporate advisory and capital markets seems to be truly firing on all cylinders. Their net profit jumped an incredible 88% year-over-year to Rs 77 crore. But what's maybe even more compelling is that they've achieved the #1 position in equity capital markets for Q1 FY26. They managed 10 marquee transactions. Now, that's not just a ranking, it feels like a strategic coup, right? It signals their aggressive comeback and their ability to capture significant market share in that space. And they mentioned a robust pipeline too. 45 filed IPO transactions, adding up to a massive Rs 100,000 crore that potentially sets them up to dominate upcoming IPO cycles. So this segment, serving institutional, corporate, government, ultra-high net worth clients, is clearly a growth engine right now.
Wow, that is an impressive turnaround for their advisory arm. How does that compare to, say, their wealth and asset management division? Is that seeing similar, explosive momentum, or is it a different kind of growth story there?
It's a different beast, definitely, but still strong in its own way. While the overall wealth AUM assets under management grew a healthy 7% year-over-year to over Rs 1.14 lakh crore, the real story, I think, is in the recurring AUM. That surged by 37% to Rs 31,180 crore. Now, recurring isn't just jargon. It means more predictable, stable fee income from long-term client relationships, which signals a shift towards maybe higher quality, less volatile revenue streams, which investors usually like. Their net profit climbed 69% to Rs 38 crore, and they're clearly in expansion mode. Opened 13 new branches, total 68 now. And crucially, boosted their sales and wealth RM's headcount by a significant 45%. They're up to nearly 1,000 people there, indicating a really robust push for new client acquisition. Even their mutual fund AUM saw a nearly 50% year-over-year increase, so solid growth across the board there.
Interesting. Very different dynamics. And then you have the private markets segment. This one delivered a truly phenomenal 5x increase in net profit year-over-year, hitting Rs 278 crore. That's a huge jump. What on earth is driving that?
Yeah, that 5x increase, it's primarily driven by strong recoveries in real estate stressed assets. See, their loan book, particularly in real estate, has been significantly reduced down 62% year-over-year to about Rs 2,655 crore. JM Financial Asset Reconstruction Company Limited, which is a key player in this segment, they accounted for Rs 1,368 crore in recoveries just over the last 12 months. And those funds were primarily used to repay debt. So it's really about cleaning up and monetizing older assets, which is a strategic win, of course, but it's different from, say, generating profit from new lending. This segment also covers things like private credit and investments like private equity and REITs.
Okay, so that explains the big jump there. And what about affordable home loans? That seems like a very different kind of business, probably a unique risk profile too.
Indeed, very different. While its net profit actually saw a modest decrease, 15.8% year-over-year down to Rs 14 crore, the underlying business is growing quite nicely. Its AUM grew by a healthy 29% year-over-year to Rs 2,911 crore. And disbursements, the actual loans given out, increased by 66% year-over-year. They've also expanded their branch network significantly up to 128 locations now from 112, and grown their customer base by 38% to nearly 25,000 customers. It's very focused on a granular, secured loan book. The average ticket size is only about 10 lakhs. And critically, their gross NPA and net NPA figures, non-performing assets, are impressively low, 1.5% and 1.0% respectively. So those may be unfamiliar. NPAs are basically loans that aren't being repaid, so keeping these numbers so minimal shows JM Financial has an exceptionally healthy loan book in this specific segment. That's a huge foundational strength, particularly in lending.
Good context there. And finally, just to round it out, the Treasury and Others segment.
Right. That segment's net profit stood at Rs 47 crore. It was up 35% year-over-year. That largely just reflects the returns they're getting from their unallocated surplus funds.
Okay, so bringing all these segment numbers and the strategic shifts together, what does this all mean for the company's overall financial health, its stability, especially when you look at the balance sheet, the key ratios?
Well, stepping back and looking at the bigger picture,
The balance sheet tells a pretty clear story. It's one of increasing financial strength and actually a more conservative posture. The company has made a real concerted effort to reduce its borrowings. They've slashed them by approximately Rs 4,300 crore over the last year alone. And this has notably improved their debt-to-equity ratio. It's down to a very healthy 1.0x compared to 1.4x a year ago. That's significant because, well, a lower ratio means less reliance on borrowed money, a more robust capital structure, less risk generally. Furthermore, there was a net reversal of impairment on financial instruments of Rs 204 crore. Essentially, they recovered more than they had previously set aside for potential losses, which is obviously good news. And the return on equity, the ROE, for the quarter was an impressive 18.3%. Just for context, an ROE of 18.3% means that for every 100 rupees of investor capital in the company, they generated Rs 18.3 in profit this quarter, which indicates exceptionally efficient utilization of shareholder capital. So this collectively points to what they call a fully capitalized group, basically in a very strong financial position.
That strengthening of the balance sheet sounds fantastic, definitely positive. But where might JM Financial still be perhaps vulnerable, even with these improved ratios? Are there any hidden risks maybe on the horizon that aren't immediately obvious from these numbers?
That's always a crucial point to consider, isn't it? While the numbers themselves are robust, one area that always warrants continued attention, even if it's not a direct vulnerability in these results, is the ongoing regulatory landscape, which actually brings us quite neatly to an important piece of context for this quarter.
Ah, right. Here's where it can get really interesting, because beyond the impressive performance numbers, there are always these other layers of context. What important external factors or ongoing regulatory matters should you be aware of that might influence the outlook here?
This definitely raises that important question. How does regulatory oversight impact the broader picture? So the Statutory Auditor's Review Report includes what's called an emphasis of matter. It relates to an interim order from SEBI, the Securities and Exchange Board of India, dated back on March 7, 2024. And that was followed by a confirmatory order on June 20, 2024. Now, this order bars JM Financial from accepting new lead manager mandates and public issues of debt securities. And that ban runs until March 31st, 2025, or potentially a further date specified by SEBI. Now, it's crucial to know what the auditors say here. They state that the impact of this specific matter cannot be determined with reasonable certainty. Why? Because it's still pending conclusion from SEBI. However, and this is key, their conclusion on the financial statements themselves is not modified because of this matter, which indicates it doesn't affect the fair presentation of the financial results as they stand right now.
Okay, so while the auditors aren't modifying their report, which is good, how concerning is it that they can't determine the impact with reasonable certainty? Could this potentially be a bigger problem lurking for their advisory business down the line, even if it's currently limited just to debt securities?
Well, that uncertainty is precisely why it's highlighted as an emphasis of matter. It flags it for attention. While the order, as you said, is explicitly limited to debt securities, it does not affect their role as a lead manager for equity instruments like IPOs, which is a key distinction.
Yeah.
Any ongoing regulatory scrutiny naturally adds a layer of watchfulness for investors and analysts. It's definitely something to monitor going forward. But as of now, for these Q1 results, it's not impacting the fair presentation of the reported financials.
Understood. Are there any other notable pending items, maybe things that could impact the company's financials down the line, perhaps more positively this time?
Yes, actually. There's also a pending income tax refund. It's approximately Rs 230 crore, including interest. This relates way back to the assessment year 2008 or 9. The company is still awaiting this receipt. So if and when that comes through, it would, of course, provide an additional cash inflow.
Right. Okay. So with all these strategic moves, the strong segment performance, the improved balance sheet, and also this regulatory context, what does this all mean for the road ahead? What is the management actually saying about these results and their vision for the future?
Yeah, the management commentary paints a very optimistic and proactive picture. Mr. Vishal Kampani, the vice chairman and MD, he expressed that they are, and I quote, extremely excited by the strong momentum across all our business verticals. He goes on, our performance is backed by decisive execution, be it in attracting top talent, adding marquee clients, or expanding our physical and digital presence. He specifically highlighted a robust transaction pipeline across businesses and stated that the strong Q1 operating peak gives, quote, very high visibility towards improving return on equity. This aligns perfectly, really, with their stated strategic priorities, expanding the client base, recruiting top talent, driving new asset and client acquisition, building scale, and leveraging technology for future growth. Seems pretty clear.
Okay, let's try and bring it all together then. This deep dive into JM Financial's Q1 FY26 results reveals, well, a financial services group that's not just reporting strong numbers, they seem to be proactively reshaping themselves through that strategic business reclassification and also significant transactions like the Bajaj Allianz deal. It looks like a company clearly focused on efficiency, on strategic growth, and definitely on strengthening its capital position, even while it continues to navigate these ongoing regulatory matters.
Exactly. So you might ponder, right? How will the company's refreshed segment structure and that explicit focus they have now on high-growth, high ROE businesses, how will that translate into sustained performance going forward, especially as the impact of that pending SEBI matter eventually becomes clearer, and as their non-core real estate loan book continues its planned decline? Certainly a dynamic space and definitely one to keep watching.